Every investment is subject to taxes, which can potentially take a big bite out of its overall return. That's why it's crucial for investors to understand how investments can be taxed when building their portfolio. In this webinar, Véronik Glazer and Patrice Lalande from PwC will explain how various types of investments may be taxed, some common tax mistakes that investors tend to make, and strategies they can use to minimize the impact of taxes on their portfolio. Véronik and Patrice, welcome. Thanks for being here.
Thank you.
So as we approach tax season, we generally hear a little bit more talk about two types of accounts, two types of registered accounts, the TFSA, the tax-free savings account, and the RRSP, the registered retirement savings plan. Can you tell me a little bit more about the guidelines surrounding these two types of accounts?
Simply put, a tax-free savings account is kind of a tax-free zone. So basically, you put money in, subject to some limitations. The revenue accrues in the account free of tax, and you don't pay tax when you take the cash out because you didn't get a deduction when you put the money in the account. On the opposite hand, an RRSP is an account where you get a tax deduction when you put the money in the account. The revenue accrues in the account free of tax again, and then when you move and when you take and you withdraw the cash out of the RRSP, then you're still liable to tax. So both accounts don't generate taxable income, but one gets you a tax deduction when you put the money in, and the other one doesn't.
Okay, so within these accounts, we don't really have to worry about that income. Outside of those registered accounts, we do. Having talked about all these different types of income, what types of income could your investments yield?
Well, generally speaking, you can say for investment purposes, you got kind of four types of income. So you got your capital gains, which is the lower taxed, talking about 24 to 27% of tax rate, depending on the provincial jurisdiction. Then you got your dividend income. So dividend income will range for eligible dividends. So when dividends paid out of public companies, about 30 to 40% tax rate, again, depending on provincial jurisdiction. Non-eligible dividends that generally come from private companies. So less, something that you're going to see less from your typical portfolio investor, ranging from like 42 to 49%. And then finally, you've got your interest income or business income, and we're going to come to those clarifications later on, with a tax rate of 48 to 53% tax rate approximately. So you can see capital gains is really what we're looking for in terms of a lower tax rate.
Well, of course, that's always the case. Let's dive into each one of those because I think it's really important for our discussion today. Talk to me a little bit about capital gains, because we hear most about that when we're talking about taxes and our investments. What is a capital gain, and how should we look at that?
A capital gain is, simply put, is when you dispose of capital property for proceeds that are higher than your cost base. So, and so for investment purposes, it means that capital property is generally a property that you purchase for its income generating properties and that you resell at a profit. Currently, the inclusion rate of capital gains is only 50%. So when you have a capital gain, say of $100 when you sell property, then you only include $50 in your taxable income. Hence the low rate of tax on capital gain as opposed to the other types of income.
So I know stocks, they also generate dividends, and I'm assuming that dividends are treated a little bit differently than capital gains. So how are dividends treated in the way of income?
Well, when a person receives a dividend from a Canadian corporation, usually the tax rate on dividend is lower than tax rate on, for example, other type of investment income. And the reason why is that the goal of the government is always that if you use a Canadian corporation, you should pay the same amount of tax corporate tax plus personal tax than if you don't use a Canadian corporation. And so that's why, because the Canadian corporation already paid some taxes on the income generated, the person receiving the dividend will pay less tax compared to other type of income. And so there's two types of dividends. So we have the eligible dividend and the non-eligible dividend. And the tax rate is not the same. And again, it's because depending on how much tax the Canadian corporation paid, well, it will have an effect on how much tax the person is going to pay, the person receiving the dividend. And so, for example, a non-eligible dividend, the tax rate is more than an eligible dividend. And the reason why is that if you pay personally more, it's because the Canadian corporation paid less tax. And if you get an eligible dividend, and so you pay less tax, it's because the Canadian corporation paid more tax compared to a non-eligible dividend. So there's two types of dividend, and it needs to come from a Canadian corporation and not from, for example, a foreign corporation.
Okay. And how would we know? Is it essentially when we get our tax documents, we'll know whether it was an eligible or non-eligible company, correct? When it comes to
Exactly.
dividends?
So usually the person will receive a tax slip, and it will be mentioned if you receive, for example, an eligible dividend or a non-eligible dividend. And so after that, when you do your personal tax return, you will say, oh, I receive an eligible dividend, so I'm going to pay this amount of tax, or I receive a non-eligible dividend and I'm going to pay, more tax if it's a non-eligible dividend compared to an eligible dividend.
Okay. So you also mentioned another type of income called interest income. So what sort of products generate interest income?
So interest income, when we talk about publicly available investment vehicles, generally going to generate from maybe bonds or treasury bills, that type of products. And essentially, what happens is that, again, I was making mention earlier about capital gain versus other types of income. If you have a bond, for example, that yields a 3% interest rate, and if you're lucky enough, then if you purchase that bond on the secondary market, or you sell it before it comes to term, there might also be a capital gain component to that obligation, simply because of the fluctuation in interest rate on the market versus on the rate of the actual investment. So you really need to be careful about when you purchase this type of investment and when you sell it, because that might yield some different tax results.
Okay, I see. So the interest coming from, let's say in your example, a bond, that is interest income. But if you were to buy a bond at a price and then sell it maybe at a higher or lower price, then we're now talking about capital on that part. So we could have both that we have to take into account, right?
Absolutely. So when you sell, say you sell a bond before the actual coupons comes to term, in your sales price, the tax regime is going to deem a portion of your sales price to be accrued interest, and the rest, if the market rate is different than that actual coupon rate, then that difference might create a capital gain or a capital loss on that disposition. And again, somebody that purchases it at issuance and takes the investment all the way to term will not have to worry about this stuff. It's only when you purchase and sell outside of the regular issuance date or term date.
So let's talk about that business income then. Where does that fall in with all of these, with our investments?
There's circumstances when you can actually generate business income from trading. So think about a day trader, somebody that actually trades on a regular basis. Talk about a broker. That's a broker's business is actually trading. So a broker trading for himself will generally create business income and not necessarily capital gain. So for an individual, then the question becomes, what's the objective of the individual when he purchases a property? So for example, if you purchase a property for the purpose of reselling it at a profit, the tax authorities generally consider that that's business income. We call that an adventure in the nature of trade in some instances. So that would be taxed as business income and not as capital gain. So if you're highly leveraged, if you trade on a regular basis very often, how long you hold some investments, I mean, these are all factors that can actually trigger a change between a capital gain treatment and a business income treatment, which yields to double your tax rate. So that's a significant impact.
So people these days have a little bit more time on their hands and doing a lot more trading during the day. But let's just clarify a little bit what day trading is.
And so it is very difficult to say, well, this person is doing a day trading, but it's more about different, condition, I would say. Do you keep your investment for a long period of time? Do you sell, buy every day? I would say that if a person has, a day job and spend maybe, I don't know, 20 minutes per day doing, buying, selling stock, maybe it's not day trading. But if a person, invests about, I don't know, 10 hours per day, buying, selling stock, probably it is, day trading, and probably it is business income and not capital gain.
What about if you're holding a foreign currency or your stocks are in foreign currency? How do we translate those in regards to income? Does it translate over into Canadian income? How does that work exactly with foreign currencies?
Yeah. So for Canadian tax purposes, a foreign currency is generally seen as another type of property. So it's not actually currency. So technically speaking, for example, you purchase shares on NASDAQ, then you need to put some Canadian dollars and you basically convert your purchase price in Canadian dollars at the time of acquisition. And then same thing you do at the time of disposition. So your foreign exchange gain or loss component is actually built in your product. But you could also generate some foreign exchange gain or loss on the currency itself. If you buy a large number of US dollars, for example, and then you reconvert them back into Canadian dollars at a later point in time, that portion could also get you a foreign exchange gain, which would, again, based on the same criteria that we talked about earlier, generate business income or capital gain. So it's when you start dealing with foreign currencies, and especially for taxpayers that have a significant amount of foreign currencies, it can get very complicated. Just first computing the amounts and then tracking the amounts. You can then ask yourself, how do I track it, and how do I find a filing position for my tax returns to actually make sense and make sure that I capture all the gains or losses. So for an investor that doesn't do a whole lot of foreign currency trading, maybe not so much of a problem, but for investors that deal a lot and keep a lot of foreign currencies in their accounts, then that can get more complicated.
In the end, we're just going to make sure we have good records to be able to back all of this information up. So you've both worked in this industry for quite a while, and so I'm just going to ask you, what are some of the common mistakes that you've seen over the years?
So one thing for TFSAs, be careful. Day trading the TFSA, I strongly advise against it. I mean, if it's ever considered as business income, and there are CRA positions out there that essentially say that if you start generating business income in your TFSA, and that income can actually become taxed, and it can have some deregistration implications for TFSA. So not a good thing. And also, if you're owning some foreign investments, if you have a choice between your RSP and your TFSA, for example, stocks of a foreign corporation that pays dividends, there's generally withholding tax exceptions for investments that are owned by an RSP, which generally don't apply for a TFSA. So if you got a choice, invest in foreign entities in your RSP and not in your TFSA. So that's one interesting one.
I would say that a common mistake is that regarding foreign tax credit that I mentioned before. And so because Canada has a lot of tax treaties between the different countries in the world, well, technically, according to a lot of tax treaties, the amount of withholding tax is usually, for example, 15%. But there are some countries, for example, Switzerland or other countries, that they will take about 25 or 30 or 35%, but you cannot claim 30 or 35%, foreign tax credit in your tax return, even though you technically paid 30 or 35%. But you should not have paid this amount because you have the tax treaty. So technically, you can only claim about 15%. And with some countries, you need to complete some forms in order to get back the difference between what you actually paid and the 15%. It can be very, difficult. And so sometimes if the amount is not that important, the person will not complete the form. And so about, 30%, 35% tax will be paid outside of Canada, but only about 15% will be claimed as a tax credit in Canada.
Okay, and it's just a bit more complicated. You would have to file directly with those countries.
Yeah, which is very difficult if you don't speak the language. It can be very difficult. So that's why a lot of people say, for $1,000, $2,000, I'm not going to complete the form. And so, yes, I paid 35% withholding tax, and I'm only going to claim 15% as a foreign tax credit.
Interesting. Investors must want to consider those types of hassles when investing in international markets. Patrice, do you have any other mistakes that you'd like to mention?
Something, yeah. So another type of mistake is somebody has a capital gain and has some other types of has some built-in losses on some investments and says, I'm going to move those losses, those investments to my RSP and generate a loss. So that doesn't work. So if you actually take properties and sell them or transfer them to your RSP to essentially trigger a loss, that doesn't work. So essentially what's going to happen is that your loss is going to be lost. So you're never going to be able to claim it. So word to the wise, if you have a loss and you want to trigger it, forget about transferring those assets to your RSP. You'd better sell them or keep the property and hope it's going to go back up. But don't move it to your RSP.
Now, does this apply to the TFSA as well, or just the RRSP?
Oh, it also applies to a TFSA. So be mindful.
So let's move on to something in regards to our strategies. What kind of strategies can we use to, help us during this tax season?
If you want to buy asset that you will pay more taxes, for example, interest income, it's better to put those assets in a registered account and probably keep, personally other type of asset. For example, shares of Canadian corporation that you will receive eligible dividend or non-eligible dividend. And so it is important, I think, to, know what you need to put in your registered account versus what you need to keep personally, just in order to pay the less amount of tax.
I know I have heard about deductions of interest. Is that something that we do have to be aware of?
I think it's very important, and a lot of mistakes are actually made regarding, for example, interest paid on the loan or professional fees. And so regarding interest paid on the loan, if you have a loan with the bank, for example, and you use the money to buy, marketable securities or other type of assets, there is a chance that you won't be able to deduct the amount. And it is because if you bought asset and the only way to generate income is because you will create eventually capital gain, you cannot deduct the interest paid on the loan if you bought asset that you can only generate capital gain. But if you use the money from the loan to buy, asset that can generate interest income, foreign dividend, you will usually be able to deduct the interest paid to, for example, a bank against the income generated.
Yeah, and I guess a theme here is keeping good records of those transactions, those fees as well, from what I can see. I've heard of a thing called capital loss carryback. What is that exactly?
So if you generate 1 year capital loss, and in the same year you did not generate capital gain, so you created a capital loss, but with no gain. And so what you can do is that you can carry back the loss to the last 3 years. But if in the last 3 years you did not generate capital gain, you still can use the loss in the next, well, actually forever. So if, in a few years you generate capital gain, you can use the loss that was created in the past in order to reduce the amount of gain. And of course, if you reduce the amount of capital gain, you will pay less tax compared if you do, well, nothing and you just created a loss that you never carry back or carry forward.
And what is there to say about income splitting?
Well, income splitting, I think there's some condition that you need to meet in order to be able to do income splitting. But in general, it means that, for example, if one person generates a lot of income, at some point, the person is going to pay a lot of tax because you will get to the highest tax rate, which is, for example, in Quebec, 53%. But there's a chance that, for example, a spouse or your kids doesn't really generate a lot of income. And so what you want to do is use these people in order to reduce the total amount of tax that needs to be paid. And so you can do income splitting, but like I said, you need to meet certain condition. And usually the way you can do it is that you need to do a loan between you and your spouse, or you create a trust and you do a loan between you and the trust. The loan needs to have an interest rate, and right now it's about 1%. The interest every year needs to be paid by the end of January the next year. It needs to be paid cash, not just say, it's going to, create an additional debt. And so if all of the conditions are met, the income generated can be split between a spouse, between your kids. You can use a trust in order to use the spouse and the kids. But it needs to be done carefully, just in order to avoid, the income going back to the person who did the loan, because at this point there's no tax saving.
Okay. So a lot of this does involve using more complex tax planning and really perhaps visiting a professional just to make sure that everything is on par. We're going to take a couple moments right now, and I'm going to show you in WebBroker where you can find most of the tax documents that we were talking about today.
From the WebBroker homepage, click on Accounts. Then click on E-Services. Click on Sign Me Up. Read through the consent to electronic delivery of documents. Enter the email address where you'd like to receive notifications and click I accept. All done. Any documents available for the past 7 years or from the date you opened your account, whichever is more recent, will be instantly available. What if you wanted to look at how you did on a trade in the past? If you no longer hold a stock, it no longer shows in your holdings. That's where the gain and loss page comes in. On the gain and loss page, you can see all of your closed trades over the past several years and get a clearer picture of which stocks made you money and which ones cost you. Again, there are multiple views. If you want to see how you did on a particular security, use the Buy Investment view. If you want to see how you did on each trade, click on the security's name or just use the Buy Transaction view. This gain and loss tool can be really handy at year-end when you're trying to figure out your gains and losses for the year, particularly if you trade a stock actively and want to see how you did on each individual trade during the year. Also, if you're a buy and hold income investor, you can use the Buy Investment view to see the interest and dividends you received on a security throughout the year, or select the Buy Transaction view and see each and every payment made by the stock individually. The main filtering tools, however, are found up here. This first one allows you to select the account or group of accounts you wish to look at. Next, this filter here allows you to select which calendar year you'd like to look at, and this one allows you to zero in on a particular type of security. If you want to get even more specific, you can use the advanced filter options here. With advanced filters, you can enter a specific stock name or symbol to quickly find that security within the list. Lastly, if you prefer working with spreadsheets, Webroker allows you to export this data to help you do your own analysis. This little icon with the box and arrow at the top of the page, called the export icon, converts this table into a spreadsheet. Here, you can see the account number, currency, any exchange rates that may have been applied, and even how many days you held the security for. As useful as this information may be in providing you a daily view of your gains and losses, or helping you review your year-end tax calculations, it is not intended to be an official tax document. For tax planning, we provide annual trading summaries, statements, and confirmations, all of which can be found in e-services if you're registered for online statements. Click on the Accounts tab. Under the More Self-Service heading, go to Tax Information Center. The Tax Center lists some of the most common links and questions. Let's try one. This link looks helpful. Here, we can find a link to a webinar. We can see some important dates to consider during this tax season, such as the last day for RSP contributions and the last day to file your tax return without incurring a possible penalty. What tax documents does TD Direct Investing provide, and when should I expect them? This is a great place to find out when TD Direct Investing will make tax documents available for both registered and non-registered accounts. What if you have a question that is not shown in the Tax Center links? Well, try typing it in the box. If I want to know how to make an RSP contribution, I can ask, how do I make RSP contributions? No need to type the whole thing. Just click on the question that appears most similar to yours. There you are. Visit the TD Direct Investing Tax Information Center today.
Véronik, Patrice, thank you so much for joining us today, but stay where you are. We do have our live question and answer period where our audience is going to be able to ask you some questions. So everybody get your questions ready, and we'll get to the Q&A session in just a moment.